kick off our coverage this hour with two longtime market watchers. Sadiq Adatia is the Chief Investment Officer of BMO Global Asset Management, joining us here in studio. And joining us from the TSX, getting ready for the market open, Laura Lau. She's the CIO at Brompton Funds. Great to have both of you with us. Sadiq, I'll start with you. You're right here. Nice to see you. You heard my lead in there. What's your general assessment on where we go from here?
I think it's going to be a bit of a bumpy ride from here. I think you're right. We're going to end up the year in positive territory. But there's a lot to look at, right? A lot of data. The economy is weakening. There's no doubt about that. We are seeing job losses. But at the same time, what we are seeing is a strong consumer, savings that are still relatively high. And for the most part, companies are doing relatively well. And to me, that means that you want to remain relatively balanced in your portfolios. Don't take on excessive risk. Don't take off excessive risk. And doing that strategy this year has paid off. So I think you want to be cautious, but not being too overly cautious.
And Laura, how about you? What's your viewpoint right now?
I, pretty well on the same page with Sadiq. I do think it's going to be a bumpy ride. We're having this tug of war right now, worried about a recession coming, and then there's all this cash on the sidelines. So typically, this is the third year of a presidential cycle. It usually is the best year, especially after having such a horrible year last year. So I do think we're going to end up positive, and I do think you should have a balanced portfolio. You want to have exposure to stocks because they are the ones that are able to pass on price increases. They are able to cut costs. So I think that you do want some exposure there. But again, I wouldn't go all out full on risk.
Sadiq, what do you make of the fact, I was talking about the U.S. performance versus the Canadian performance. We do this all the time. We talk about how tech's had this big run. I mean, it's had a big run here in Canada too. It's just a smaller piece of the overall pie.
I think that's exactly it, right? It's the makeup of the composition of the indices, right? Canada's got high amount to financials and energy, both having a bit more of a difficult time. U.S. is benefiting off the tech boom, which is a bigger part of their index. I think you will eventually start seeing a bit of a catch-up at some point in time. I do think energy has a better leg up at the end of the year when China gets a little stronger in their economy. And I think that's one of the reasons why you haven't seen energy do as well, is though even though OPEC is cutting supply, what you're not getting is this strong enough demand. And I know you started off the session with that demand forecast, but that's many years out still, right?
A couple of decades.
So I do think that's just a sign to say that they don't see anything imminently either, and why you're seeing energy pull back. And financials obviously has had the cloud, not only in Canada but around the world, given what was going on in the U.S. I think that makes it tougher time.
Well, I know
the stocks outperform.
The energy bulls have sort of been pounding their head against the table this year, but they still are sort of sticking to it being an interesting place over the next 5 years or so.
And I think that's the way to look at it. I don't think you can time the short-term movements here. I think you have to think about it from a longer-term perspective.
Laura, in terms of the Canadian market, let's say, versus the U.S. market, what's your view right now? I mentioned that, well, actually, it was you who mentioned that you're seeing companies take action right now. And between stock buybacks and dividends in the interim, has it created a compelling proposition for you, I guess?
I think it's becoming more and more attractive because we're certainly seeing dividends increase. We're seeing companies pay down their debt. But the macro environment is, if the economy is slowing, and Canada is more cyclical, especially, as you said, the high weight into energy, materials, and financials. So typically, in a risk-off environment, that's not really where you want to be. But at some point, the economy will pick up. And in terms of oil, I think I said this last time, Saudi Arabia knows a lot more than you and I, and they can see the physical market. They decide to cut production. So I think that they do see demand has been weak.
Okay, and Sadiq, bringing it back to you just in terms of, you talked about sort of being, I guess, diversified. Bonds are still an area that you're leaning into right now.
Yeah, we still like bonds over cash. I think you're going to start seeing at some point the yields, potentially even coming down. I think, we look for safety. Bonds should do well. If we do have a hard recession, which is not our base case, bonds should do exceptionally well in that period as well. So to me, you do want to have bonds over cash, but you still want to remain relatively neutral. And geographically, I don't think you want to take too many bets either way. I think quality is where you want to focus on, and that's whether it's Canada, U.S., internationally, or even in emerging markets. But I do think when you think about the consumer, you have to think about the consumer will eventually start to slow down, and you will start to look at opportunities of where that money will go to, because it won't go into the typical places it would when the economy is strong. It'll start going to more of the staples, and I think the staples are an area you want to be in later on in the year as you get closer and closer to that recession, which we don't see happening until 2024.
2024. So just, you said, so your base case is what for?
So for this year, we expect the economy to continue to still chug along and do quite well. Consumer to hold up, but showing some signs of weakness. You'll see job losses in one sector or two, and then what you'll see is other sectors still looking for jobs to be hired. And so the movement will go away from higher paying jobs to lower paying jobs, but still having jobs. So you won't go from spending a lot to spending nothing, but going from spending a lot to spending a little less. And that should keep the economy still chugging along. And as you said, you know, the recession part won't be until a later part in 2023 or early part of 2024. And even that has a risk to get further pushed out as well, like we've seen so far this year.
Laura, why is it that we keep pushing out this recessionary risk? We've been talking about it, I feel like, for 2 years now.
I think that this is a recession we've never seen before. So it's called a rolling recession or rolling recovery. And part of the reason why is the economy is out of sync. In the old days, when you had a recession, nobody would buy cars, nobody would buy houses, they'd be just scared. This time around, people have jobs, you can't get a car. We're seeing a manufacturing recession because people bought all their stuff during COVID, but they're dying to get out and live their lives. So we're seeing services very strong. So what we're seeing is weakness in the goods sector be offset by strength in the service sector, such as travel and such. So as a result, we think this time the recession will not be as deep as before. And if you have a job, you keep on spending, you keep on paying your mortgage.
Yeah, and actually that kind of gets us to the final view on interest rates. Maybe I mentioned we're going to get some inflation data tomorrow. Laura, I'll come back to you for a final word. Do you anticipate the Bank of Canada raising interest rates again next month?
I do think they will, and you know, despite what this CPI number, the inflation number, comes out this week, because typically when the Bank of Canada increases interest rates, it's not just in isolation, and they had fallen behind the United States, so they're just catching up. So we do believe that the Canadian economy is stronger than anybody had expected, and they'll likely increase interest rates.
Sadiq, variable rate mortgage holders on the ropes right now. Are you anticipating another rate hike?
I do as well, too. I think the Bank of Canada took a pause at the right time, actually, and now they let the information come in to decide, you know, to continue on with that. The Fed will probably do a similar thing as well. Well, they will sit on the sidelines to watch a few more economic data points before they decide to pull the trigger.
Okay.
Well, let's speak to our next guest now. He's Kash Pashutin, Chief Executive Officer of First Avenue Investment Counsel, and a frequent guest on our station. Thanks for coming in.
Thanks, Paul.
So we are very, very nearly at the end of the first half of this year. What is your take on the markets thus far, and what is your call on the remainder of the year?
Really, Paul, two themes stand out to us. One is how narrow market leadership has been in terms of stocks going higher. As we've talked about in the past, you look at the headlines and it suggests that it's been a great year for equity markets, especially the U.S. The S&P, as we know, is up 15% year to date, which is an exceptional return 6 months into the year. When you dig a little bit deeper, you see that, unfortunately, that return is very much skewed to a very small handful of stocks. About 7 stocks represent 85% of that return. So many stocks on the S&P 500 are flat to negative this year. And so that is not the sign of a healthy market. And although investors feel enthused about a year-to-date return of 15% in the broader market, things can change very quickly if those handful of tech stocks do not keep up the momentum that they've had so far this year.
Okay, let's move to a sector that you do like and I understand are buying on dips in share prices, and that's the U.S. healthcare sector.
Absolutely. You know, investing is about setting your portfolio up for not next quarter, but for the coming 5 years. And when you look at high-quality sectors within, especially a large market like the U.S., healthcare really stands out, primarily because of how it's performed this year compared to the broader market. The S&P, as we said, is up 15%. Healthcare is one of the greatest laggards, down 2%. And that's a sector that historically needs to be a big part of a well-balanced portfolio. It's low beta, it's defensive. Generally, you get yield. So there's a lot of positives with that sector, and to be able to chip away at some of the higher quality names when it's down in a year where the market is up is opportunistic.
One thing that's happened is that elective surgeries have increased in volume a great deal since the pandemic, when they were largely not happening at all. What effect has that had on the share prices of some of these companies?
Yeah, so for example, when you look at a company that we own that we do like here, United Health, they would be what's called a HMO, Health Medical Organization. Essentially, think of it as providing health insurance benefits for a monthly fee. That stock's been hurt because of the delay now sort of playing out with post-elective surgeries, because the medical cost ratio, so basically what are they collecting in terms of premium and fees and what are they paying out, that ratio has been skewed to the downside, because with all of those elective surgeries being delayed, they're now starting to really happen. And of course, there's a cost for those surgeries, and the benefits provider, that cost is borne by them. But these types of events are short-term in nature, and we believe that next year, as the backlog of elective surgeries catches up, they will recoup their margins to where they are. So again, if you're taking sort of a 2-3 year perspective, United Health looks attractive because of the pressure that it's faced on its share price with those post-elective surgeries.
You also like CVS. We think of that as a pharmacy store operator because when we travel to the U.S., we see those stores everywhere, but there's a lot more to it than that.
Absolutely, and that's the key. You know, when we think about, for example, Suncor, we always talk about it's integrated, it's involved from A to Z when it comes to the commodity. CVS is similar. It's fully integrated from all the way from the health insurance benefits business that they have, all the way down to the retail pharmacy, which many know. So it's really touching all aspects of the healthcare as it relates to the consumer. And really, it's about a buying opportunity in terms of valuation. This is a stock that has compounded at 10% a year for the last decade. And currently, you're getting an opportunity to buy it at around 8 times multiple, where historically it's traded at around 14 times multiple. So you're getting a 3.5% yield, which is great because, as we know, U.S. stocks tend to not pay the same sort of dividend and yield cash flow that you would get with Canadian names. And it's an opportunity to buy it at much lower valuations than we've seen historically.
Okay, I know you've got some thoughts as well on a completely different sector. That's retailing, and specifically dollar stores. And you prefer our flagship dollar store operator, Dollarama, to some of the publicly traded competitors in the U.S.
Exactly. So the U.S., unfortunately or fortunately, depending on how you look at it, provides better growth opportunities than Canada in a variety of industries, but the dollar store model, not so much so. And it's a variety of reasons. Number one, there's a lot more competition in the U.S., so there's 2 large players in the dollar store in the U.S., only 1 in Canada, and then there's also several mid-size. So from a competition landscape perspective, much more dominance from a dollar store perspective here in Canada. The other side of it is, what's the product lineup? So the dollar store model in Canada is much more simple, I would say. For example, there's no fresh foods. You don't need coolers, freezers. So their overall floor plate and CapEx spend is quite a bit lower than what the model looks like in the U.S. So that, combined with competition, does provide considerably more benefit. And you see that in the operating margin. So in Canada, the dollar store is operating with a greater than 20% operating margin, where in the United States, it's about 10%. So competition, less CapEx, results in higher operating margin, and that's the driver to why we see more opportunity in Canada compared to the US. We've held both in the past, but currently we just own dollar store in Canada.
This with Royce Mendez, who's Managing Director and Head of Macro Strategy at Desjardins. Nice to see you, sir.
Nice to see you as well.
So, I don't know, it feels like a bit of a tug of war out there, the Bulls versus the Bears. How much of the economy and where we go from here is at the center of it, in your opinion?
I think the key word is resilient. We've seen it in a lot of the economic activity data. You mentioned the GDP revisions today. It all points to the fact that interest rates are not working as they were intended to do or as they were expected to do. We came into this year with a lot of people bearish on the economy because interest rates had been raised at a historically fast pace. And they just haven't done what a lot of people expect them to do. They haven't slowed economic activity as much as some economists expected, and they haven't pulled inflation down. If you look at underlying inflationary trends, they're still too high to be consistent with the Federal Reserve or the Bank of Canada's 2% target.
And so against that backdrop, like let's forget about everything else and let's look at inflation data and the tools that central banks have. What are your expectations? I referenced, the market. I'm even just looking at the swaps market this morning. It seems like that expectation will see another couple of rate hikes is what the expectation is right now.
I think that's probably right. But surprisingly, when we got the Canadian CPI data, there were a lot of economists cheering the fact that headline inflation had fallen to pretty low levels. The problem is that the real story is on core inflation, and it's the core inflation metrics that the Bank of Canada is tracking.
While you're talking, can I just maybe throw we like our charts, and I know you like your charts too. We may have a chart which just shows some of the services inflation in the economy as well. That's, to your point, easing inflationary pressure depends on what prices we're talking about.
Yeah, that's exactly it. What we want to do is we want to strip out all these volatile components. And of course, we want to strip out those mortgage interest costs that people are all talking about.
Sure.
The fact that the Bank of Canada raises rates and that actually feeds into higher inflation. We want to exclude that from the calculation. So we look at things like the Bank of Canada's core, median, and trim. But specifically, we really like the Bank of Canada's core services excluding shelter metric. And that is still very elevated. All of the core metrics, though, you'll see there are just moving in a sideways trend. That's a problem. The Bank of Canada wants to see progress towards the 2% inflation target. And when you look at these core numbers, they don't show progress.
Is there a possibility, though, like services is a pretty general area, but if I think people, are traveling and have been willing to get back out and go to Taylor Swift concerts or whatever they're doing right now, but if the economy does start to cool down, that they might spend less on those things, and that might ultimately bring down services inflation.
I actually think it was Beyonce who was blamed for the inflation.
Yes, that's right. That's right. That was true, actually.
It's true that there is some pent-up demand. It's true that there is excess savings in the bank accounts of Canadians. But if you look at some of the employment numbers, if you look at the economic activity numbers, even after accounting for population growth, they're still very strong. And we can't just hope that eventually, the economy will cool down because some of those temporary factors have begun to wane. We have to take action because the longer we live with higher inflation, the more likely it is to get entrenched in the decision-making processes of businesses and households.
So you think the Bank of Canada does what from here? How many more rate moves could they potentially have going forward?
I think July is very likely that they raise rates. I think globally what we're seeing is central bankers talk about further rate hikes. And I think there is a risk that the Bank of Canada needs to do more after that. But I think you are seeing globally a coordinated effort amongst large central banks to try to get control of this second phase of inflation. The first phase was the easy part. The first phase was getting inflation down from 8 or 9% in North America down to these 3 or 4% levels. The next phase will be getting it back to 2%. And that was always the part that people worried about having problems, where things might get sort of stuck at a higher level. And that's what we're seeing in the underlying inflationary data, is that things have gotten stuck.
I do want to tie it back to the broader markets and their assessment of all this stuff. Before I do that, there's so much focus on central banks, but governments around the world have done plenty of spending, certainly going into the pandemic and even coming out of it. We actually had an interview with the NDP leader, Jagmeet Singh, yesterday. It was in New York, I guess meeting with different people about strategies on dealing with inflation. And he has looked to taxes on excess profits in the corporate world as a way to address inflation right now. But I asked him about the fact that the IMF itself has said maybe Canada should have a fiscal anchor on our spending. How challenging is it to say, oh, these central bankers have to tackle inflation when governments are still spending oodles of money?
In theory, it would be great if you could tax excess rents. In practice, I don't know how you do that. So I'm not sure that that's very practical. I think when you look at what governments around the world, and in North America, and we can talk about the governments here, they're not rowing the same way
as monetary policymakers, and that's not helping. While I think, the fiscal impulse is not necessarily hurting because we're spending less than we were in years past, it's not necessarily helping, and it's not a great sign that when we're at sort of full employment, we're at the top of the economic cycle, that we're not really running, closer to balance in terms of budgets.
So before I let you go, let's tie it back to the market. So there's obviously more work, it seems, in your view, to be done by central banks to fight the inflation story. I wonder if the willingness of investors to at least keep tabs on what's happening in the equity market, it ties back to the fact that if the economy is resilient for now, if it hasn't turned over, then why would I jump out of that boat for now?
Absolutely. It makes complete sense. The economies have proven far more resilient. The worst case scenarios that people were worried about at the beginning of the year did not come to fruition. And the economy and by extension profits are proving to be pretty strong. The problem is that we have to think about what the end goal of the central banks is. And it's to get the economy back into some equilibrium, which is just code for slowing it down. And unfortunately, it's hard for them to calibrate that slowdown. So while they're aiming for a soft landing, it'll be very difficult to achieve that.
Joining us now to talk about the markets and some stories that are out there is Chris Kurlau, Senior Portfolio Manager at Canaccord Genuity's Team LWC. Thanks for coming in, Chris.
Thanks for having me, Paul.
There's lots to talk about. Let's talk about Jerome Powell hammering forward that message. Now he's in Spain saying the same thing that he said to U.S. lawmakers last week, and that is that you can count on 2 rate hikes before the Fed is done dealing with inflation.
Yeah, I caught the transcript this morning as it happened overnight in our time, but he said the majority of FOMC members believe they'll need 2 more rate hikes this year. That was probably reinforced with the strong GDP data we saw this morning, revised up to 2%. Payroll data, the weekly indicator, kind of missing expectations is a bullish thing, less people filing for unemployment. I think, and surprising, the markets are taking good news as good news, taking it in stride slightly higher today.
And we've also got news in the banking sector. A couple of banks have gone to the Fed, their chief regulator, and said, are we in shape to raise our dividends? In other words, they've passed those stress tests that are a fact of life for big U.S. financial institutions.
Yeah, this is the annual stress test that they go through every year. A lot of the banks did much better than expected, which certainly opens the door for a variety of dividend hikes across the sector. We really like the U.S. banking sector. We added a position in ZUB, which is an equal weight banking CAD hedged ETF to get further exposure in the LWC model portfolios. That CAD hedge has also worked out well this year, or actually this month, following the surprise rate hike from the BOC. We're seeing a year-to-date high nearly on the CAD. And the banks are a beneficiary of being able to, give money back to shareholders, which is great for, people that own those stocks.
And we're really seeing a reaction, aren't we, in the U.S. banks today? We just cycled through a number of them. I think a number of those haven't yet got to the passing the stress test stage, but the judgment of investors this morning is that as a group, the stocks look attractive.
Yeah, totally. We added to that position following the SVB regional banking crisis. We didn't see that as a systemic risk. The large money center banks in the U.S. were kind of thrown out with the baby in the bathwater, in our opinion, and still trading at reasonable levels with high loan loss provisions. If this recession, does hit us, we think it's going to be shallower and less than expected. And so as those loan loss provisions roll off, earnings should benefit from that.
How do you view the U.S. banks and their appeal to investors versus the Canadian banks?
We're owners of banks on both sides of the border. The Canadian banks, with the U.S. exposure, TD, BMO specifically, have lagged the Canadian domiciled national RBC counterparts. We're owners of TD and BNS and the LWC Canadian High Dividend Portfolio. Same story there. These banks are trading at recessionary levels, large loan loss provisions. Looking at it from a 15-year price to book, price to earnings, you're kind of at the bottom of that trading range. So, could things go lower? Obviously, always. But We think that it's an asymmetrical return profile from here. And you look out 3 or 4 years, I think people look back at a good buying opportunity.
You mentioned that you bought the CAD hedged version of that ETF. That's a Canadian dollar hedged version of ZUB. That's a BMO ETF that holds shares of the U.S. banks. It's available in an unhedged version as well to investors. Tell us why you've chosen the hedged version.
That's just from an overall portfolio currency exposure. We kind of have been making that hedged move coming into the year. We did that on some of our global equities at the start of the year, and again once here. A bit fortuitous bounce following that rate hike, but the global reserve currency, the U.S. dollar, is down to 59% market share from 71% about 2 decades ago. Commodities have obviously troughed, so we think we're bullish on the materials sector, and that could lead to another leg higher on the Canadian dollar. And then, the petrodollar is now, we're seeing other currencies settling, commodity trades, particularly in natural gas and oil. That's kind of the first time that's happened. And so we're kind of bullish on currencies outside of the U.S.
You say commodities have troughed. Do you see higher, for instance, copper prices and oil prices in the second half of this year?
It's a short time horizon. If we move into, negative economic data, that's not going to be good for those economically cyclical commodities that you've mentioned. But a lot of the gains on inflation have really been from this commodity complex trading lower. You look back a year ago today, oil was $110, it's $70. Nat gas was $6, it's below $3. Copper, wheat, corn, all kind of in a lower trading range than they were a year ago. And that's really not the type of inflation I think Jerome Powell and the Bank of Canada are looking to ease. Obviously, that flows through the economy as the feedstock in much of that we consume. But it's that services inflation that's remained sticky. And we've seen a massive move higher on economic surprises, both in Canada and the United States, which I think kind of gives the Fed and the Bank of Canada the ability to maybe do a few more rate hikes here.
What are your thoughts on the tech stocks, which have led the market higher this year, at least a small group of those mega cap techs?
Yeah, we've been trimming our exposure specifically in NVIDIA and Uber. Still have positions in the names, but have been taking profits along the way. Clearly, that's led the market higher. If you look at the equal weight S&P 500, it's recovered, but not nearly as much. But a lot of people think that this is a bear market rally. We're getting close to that Fibonacci band on the equal weight index, and I think if we pass that, which is about roughly 2/3 of the retracement of the pullback, it's hard to call this a bear market rally, pardon me, and possibly the start of a new bull market. We think there's probably more risk still being out of the market, but active management, active security selection is something we're tilting clients towards, and repositioning our portfolios from a more passive tilt back in 2022.
Explain briefly that Fibonacci band, that threshold that the markets are getting close to.
So this is the golden ratio that my good friend Derek from Purpose would always be talking about in our investment committee meetings. But these are kind of things that happen in the world naturally, and just key technical indicators that something we keep an eye on.
Welcome back. Shein, the Chinese online fashion retailer, is best known for its quick response to online fashion trends and for producing thousands of new products a day. It gained worldwide popularity during the pandemic. It's now estimated to be worth about $64 billion US. We're joined by Peter Pernod-Day. He's global head of strategy at Shein. He's based in San Francisco, but in town today here in Toronto to speak at the Collision Conference later this afternoon. Thank you for coming.
Thanks for having me, Paul. Pleasure to be here.
Thank you. The company has been a remarkable success. It has become the dominant player in the U.S. market in fast fashion, eclipsing names like Zara and H&M. How has it done that?
I think one of the keys to our success is our on-demand business model. This allows us to produce ultra-small batches of products between 1 and 200 garments. In response to real-time demand, we can ramp up production if we measure a demand signal. This allows us to put our customers first and to really meet needs while dramatically reducing inventory waste.
And you get that data on customer demands from the app. The app is a big part. At one point, I understand it was the most heavily downloaded app in the U.S., and it is now, I believe, the most heavily downloaded fashion app in the U.S. Is that correct?
The way that we interact with our customers is through our web store, which is a web-only application, and then we also have a mobile application, which is quite popular. and we look at user behavior on those properties, and we use that to measure demand signal.
And tell us more about that. Are you using artificial intelligence to interpret that demand?
We use machine learning, and we marry that to our network of federated suppliers. These are third-party contract manufacturers who work with us. And through a supplier management system, we're able to share information about demand so they can structure their operations to meet our customers' needs.
The company, is it correct the company does not sell in China? And if so, why not?
The company sells outside of China principally. We're based in Singapore, and our mission is to meet our customer base globally. Wherever they are, that's where we'd like to be.
And why not China?
We see that the Chinese market, when we entered in 2012, was quite saturated, and so we made the decision to focus on markets outside of China.
What is your presence like in Canada, and what are the company's ambitions like in China, in Canada, rather?
So in 2022, we opened a 170,000 square foot distribution facility in Markham within the Greater Toronto area, and we're hoping to continue to expand our team on the ground in Canada. We'll be opening a pop-up store in Montreal in the coming months, and we're very excited about that opportunity. The Canadian market, together with the North American market, is very important to Shein, and we're looking forward to continuing to grow here.
Is the company considering going public? It's been reported in the financial media that a U.S. Public listing is part of the company's plans. In fact, was part of the company's plans back in 2020, but the company retreated from that plan.
We have no current plans to go public.
Okay, let's show viewers something that's been reported about the financials at Shein. Reuters reported earlier this year that it is aiming to list in the U.S. this year. That its current value is estimated at $64 billion, that a sovereign wealth fund in the United Arab Emirate Republic is a backer, and that Shein did, in fact, shelve an IPO plan back in 2020. There are also, as I think you know, very public controversies about some of Shein's business practices, and we can show our viewers a summary of that as well. A U.S. agency known as the U.S.-China Economic and Security Review Commission has made allegations, as you know, about forced labor and the source of where cotton is coming from in China, the violation of labor laws and principles in China, and copyright infringement claims as well. Does the company have any public response to these issues?
Shein has zero tolerance for forced labor. We have no suppliers or contract manufacturers in the Xinjiang region of China. We have a comprehensive supplier code of conduct that applies to all of our suppliers, prohibits forced labor, child labor, or illegal labor practices. In addition, we've conducted comprehensive audits across our supply chain, including 2,800 in 2022, with a planned 3,600 in 2023 to ensure that our contract suppliers are meeting their expectations and standards.